Okay, folks, Kev here. We're trying something new. We understand that our shows sometimes run long, and not everyone wants to hear 3 hours of crayon chewing. So we have decided to create Market Huddle Plus episodes that will be shorter in length and straight to the point. They will feature new and old guests and a variety of topics. The only promise we have is that they won't run as long. So, in that spirit, welcome to the first Market Huddle Plus episode featuring a bull and bear debate with Chase Taylor from Pinecone Macro debating Jay Pelosky from TPW Advisors. Hey guys, welcome to the show.
Thank you.
Thanks, Kev.
I felt a little bit like Scott Wapner when he was asked to referee between Bill Ackman and Carl Icahn. But I know you two are much, much nicer, and there's going to be no gloves are going to come off, and this is going to be a gentleman's debate. So, Jay, why don't we start with you? Why don't you tell us kind of in a few minutes why you think the market and the economy is better than the gloomy bears believe?
Sure, Kevin. And great to be with you, Chase. So I'm going to start by kind of referencing our most recent musings we write every Friday, and it was titled Crunch Time. And I basically made the argument that much as we are in the season of NHL and NBA playoffs, we're kind of in a crunch period with the markets too, for a couple reasons. One, I believe the Fed is coming to an end of its rate tightening cycle. And I believe at the same time, the S&P is coming to the end of a long trading range. We also have what we've been calling a curtain of FUD, fear, uncertainty, and doubt, which has been emblematic of the recent IMF and World Bank meetings, where it was the most bearish. One attendee told me that he's seen in 30 years. We also have a cross-asset playoff between sell-side equity analysts who are forecasting higher and accelerating earnings growth into 2024, and fixed income investors, on the other hand, who foresee recession and interest rate cuts as we exit 2023. Both are unlikely to be right. So in our view, we see the Fed pausing after the May meeting. Whether they raise another 25 or not is insignificant. The key is the pause. The pause is in turn the catalyst for the S&P to break out and up of its long trading range. And this is typically the case when the S&P is in a long trading range. It needs a catalyst, and typically the catalyst is in fact the Fed. So we expect the market to break up and out, to break through the 4,200 kind of ceiling and reach a new bull market, which will be around 4,300. Which is taking 20% up move from the low of October. And that will force bears to capitulate and kind of reinforce what the Ned Davis Research 2023 cycle suggests is an imminent surge in the marketplace. We see the best opportunities here as offshore, away from the U.S. In our view, very simple shorthand, a Fed pause equals dollar weakness, which equals rest of the world outperformance. And we would note that the average one-year S&P performance post the Fed rate peak tends to be 19% over that next 1 year, according to Goldman Sachs. And so that is our view in a nutshell. We believe that the economy will not go into recession. Actually, we see growth accelerating. You look at the global PMIs as an example. You look at the activity levels in Asia, which is leading what we believe is a desynchronized global economic recovery. And we think the market is just misunderstanding the rate of speed that is taking place. We are big believers that speed is a major difference between today and past periods. And so while most see us as late cycle, we believe we are early cycle, and that the US and Europe had recessionary type conditions roughly a year ago. I'll stop there.
All right, Chase, it's a pretty compelling argument to the bull side. What would you push back and say is the bear argument of why Jay's scenario might not play out?
Yeah, and I would like to say I think Jay makes as good of a bull case as anyone does. But the way I see it, we had so many rate hikes in such a short amount of time, and the lag effects hasn't really hit yet. I think what a lot of people want to believe is that lags are shorter now because of the way it works with financial conditions. And I just don't think that's the case, especially when you have, over $1 trillion in excess savings that were sitting around last year. We know that contributed to about 6% of spending last year, and that it's forecast to dry up at some point this year, and it's at least not going to be supplying $100 billion a month. So my kind of broader view is that we had just a giant one-off of fiscal stimulus, so which created obviously a demand shock, and then clearly at the same time as we had a supply shock because everything was shut down. So I kind of think a lot of the inflation really was transitory. It's just more like a 3-year transitory to like work it out of the system, all of the money, and then the supply-led problems. I think a lot of folks view wages as kind of pushing everything, and I think wages are really on the back end. They're lagging. I've kind of coined this term, the lag reaper, and I think we're going to start to see these lags like really hit in a major way in May, and that will kind of flow through into the data more like June, July. And really a lot of that is if you just go back and kind of chart the way the leading economic indicators have worked in prior cycles, and it all kind of maps onto that May, June timeframe. Whenever you have this combination of leading indicators doing what they're doing, and then the coincident growth indicators doing what they're doing, that usually you're about to go into a recession right now. So I think that's the case. I think the first thing that broke was the banking system, but I don't view this as some like scary bank crisis. I view it more as it's going to do enough to the banks for them to tighten up to a level that's going to help slow growth. But at the end of the day, what's going to slow growth is the manufacturing economy just slowing down enough to start losing jobs. And I think we'll start seeing job cuts coming up probably June, July. I think that's where they go negative instead of positive. We've already slowed down significantly, of course, but that's kind of where I see those going. We've already had banks tightening lending standards really the last year. We're seeing the deposit leakage, which is going to lead to more and more bank stress. Banks, shadow banks, everyone has interest rate risk. It's not like it was just Silicon Valley Bank that had a bunch of interest rate risk. And I think we kind of learned that here Tuesday as we had a kind of another domino fall in the banking system. The regional banks are still like at the lows. XLF, 8% off the lows, but still 21% drawdown. So banks still look unhealthy to me, and I don't really see that changing, and that will absolutely flow through into the real economy. We're already seeing in the Dallas Fed this week, there was some comments about worrying about having their lending frozen with their banks. And I just think you're going to see more and more of that as they have to defend their balance sheets. But just broadly looking at the data, whether it's NFIB or ISM or the regional Feds surveys, like you just kind of dig into the data and look at what it means historically. I think it's a big problem. Cyclical jobs are already rolling over, whether that's trucking or residential construction, temporary help, manufacturing. There's just a ton of weakness there with weakness in the work week. So a lot of the leading indicators in labor, to me, are suggesting, again, that May, June, July area is when we probably will enter a recession. And I'll leave it there and let you go back and forth with some questions.
So, Jay, your bullish argument and based around the Fed pausing, isn't it implicit in there that the Fed is going to pause in time and that the recession, they'll be able to avoid a recession and hit more of a soft landing?
Yeah, Kevin, I think that's definitely part of it. Look, we know the market equities are forward-looking discounting machine, and I think that's why the equity market, notwithstanding that curtain of FUD I talked about earlier, has been up, 7% in the fourth quarter of last year, 7% in the first quarter of this year, up in March when SVB and Credit Suisse failed. Everyone talked about rushing to cash. Cash was one of the worst performing assets one could hold in March. And if it doesn't work in March, when you have two of the biggest bank failures on either side of the Atlantic that one has had since 2008, when is it going to work? So I would point out that, the global PMIs are accelerating. The data just came out the other day. Clearly, the U.S. is accelerating. Europe is accelerating. Best growth in a year. You have Ned Davis noting that the U.S. Earnings revision, their 3-month moving average, is also accelerating. You have the Citi Global Economic Surprise Index accelerating higher. These are not suggesting that we're going into a recession. It's the opposite. This is suggesting, as the market is suggesting, that we're going higher. Housing has bottomed months ago. Transports are above their 200-day moving average. It's very rare to have a recession in the United States when you have housing doing okay. Everyone's wondering why, with the housing crash that's been in place over the last 9 months or so, construction workers haven't become more unemployed. That's where everybody typically tends to look. Well, guess what? We have non-residential construction up 17% year over year because we have the return of industrial policy to the US for the first time in 70 years, since the 1950s. And so we have things going on in the economy which no analyst active or no investor active today really understands or has experienced. And I think these are the huge positive changes that are unfolding behind the curtain of FUD. So when you pull that curtain aside and you see the return of industrial policy, the supply chain realignment, the investment in Europe in climate, in dealing with defense, in dealing with energy, when you see yield curve control likely to end in Japan with huge ramifications for domestic investor allocations, and you see the return of domestic demand-driven growth in China, where China is going to grow 6.5% or better, the second biggest economy in the world. Every single major bank is rapidly raising their estimates for growth in China. I really struggle to see how we're going to have a global recession when we have the second biggest economy in the world growing at 6% plus.
So, Jay, not only do you think that the market has gotten ahead of itself in pricing in a recession, but you would argue that we're not going to have a recession and that it might be a slowdown, I'm assuming, or something like that. If we were to have a recession, would that change your outlook, or would you still say that I expect stocks to go higher because we're going to then enter into a easing period with the Federal Reserve?
Yeah, no, I think that, as I mentioned at the outset, Kev, the playoff is between sell side equity analysts who are calling for earnings growth to accelerate in Q3 and 4 and into 2024 versus the fixed income investor base, which is clearly looking for recession and interest rate cuts as we go through the second half of the year. We're on the side of the equity analyst camp. And we think the fixed income markets have it wrong. We're not going back to the low inflation, low growth world of the 2010 to 2020 period. We're going into a high nominal growth world environment where one of the other big changes that's taking place behind the curtain of FUD is the central banks accepting a slightly higher inflation rate, somewhere around 3% or so. Martin Wolf of the FT wrote a very good piece on this just the other day. 3% inflation, 1 to 2% real yields gives you a nominal rate of roughly 4 to 5%. And I think that's where we are. And we're going to stay at those rate levels for a considerable period of time as the Fed and ECB basically accept, without making a big deal of it, accept a slightly higher inflation rate, which is driven in part by that supply chain realignment, that return of industrial policy, that public and private spending that we're seeing taking place in the climate space and elsewhere.
Right. Now, Chase, if we were to manage a soft landing, would that change your outlook? Is your bear call all kind of hinging on the fact that we're headed towards a recession?
Yeah, absolutely. I mean, if we escape the recession for the rest of 2023, then I'm just wrong, and it definitely changes the way I view this. But
and then, sorry. Go ahead, Chase. Finish your thought.
No, I was just going to counter some of what Jay
Sure.
said. On the high nominal growth, if you look at the last 25 years, nominal growth in the U.S. being at like 5, 6, 7% actually isn't that uncommon. That sounds weird, but it's not. You go back to like 2018, and we're essentially where we are now. But I think you kind of look at that nominal growth and you subtract, what 3-month bills are doing, or, pick your short-term interest rate proxy, and we weren't that tight on any of those prior really 5, 6, 7% nominal growth rates. So I think we're so much tighter than we were prior to this at similar nominal growth rates that unless the Fed's going to let real rates just stay exceedingly high, and I just don't think they can. I think that nominal growth is going to get extinguished very soon, mostly by just inflation coming, back down to I think under 3%, at least in the next couple of years.
One of the Can I just interject here
Sure.
and ask a question? A lot of your argument is based upon soft data and kind of indicators that surveys and things of that nature. One of the kind of the strange things about this cycle has been the divergence between hard and soft data. And Morgan Stanley's Mike Wilson said that eventually hard data always follows soft, and that seems to kind of be the crux of his argument of why the economy is about to roll over. I was wondering if you have any insights about why the kind of actual underlying economy has been so strong, because let's face it, there's been a lot of people who have been calling for the rollover for some time now, and it's been kind of stubbornly strong.
Yeah, absolutely. And I to me, what it all comes down to is all the excess savings. I mean, you just go look at, so everyone likes to throw around the kind of year over year M2 chart, and because it's going negative and it's scary looking, but you kind of look at just the actual basic level of M2 and it's still above trend. So and when you just look at that chart of how it just exploded higher, and you think about not only did we give a bunch of money out to everyone in the economy, but we gave such an enormous chunk to the bottom quartile that actually spends all of the money you give them. So I think you just created just a monumental backdrop for demand to stay strong. And I think those of us that were early to kind of looking for this weakness based on that soft data you're talking about, I think what we did a bad job with was kind of realizing, hey, until you burn down this excess savings, like none of it's going to matter. Like it's great that all the UMish people are fearing the end of the world, but but if they still have 20 grand in their checking account, they're probably going to keep spending it. And I think that's what we've seen. But even when you look at all the data that NBER tracks for a recession, though, I mean, most of it is at or near recession levels, except for labor. Labor's kind of the last domino to drop. And if you just kind of look at a bunch of different leading indicators for labor, they all tell you, okay, you're going to keep going in that direction, especially as credit continues to tighten.
And one of the things that I worry about is that even if you're correct, given what the fixed income market is priced in terms of their chances of the economy rolling over, couldn't you also make the argument that maybe the stock market has done the same? And that you could get a situation where you're right about the economy, but strangely, it's a sell on rumor, buy on news. Because let's face it, sentiment is really washed out, and you have to admit that you are in the crowded camp.
So I'll push back on that a little bit.
Okay.
So people are short stocks, but people are also loaded up short treasuries. So to Jay's point that fixed income traders are pricing in recession, I don't really think that's the case. I think obviously we have record shorts in treasuries, so that's part of it. But just the SOFR curve is pricing in 4% by the end of March of 2024. Like, that's not a recession to me. The terminal goes from the terminal low point, let's call it, for cuts goes down to 3%. Like, if we have a real recession, is the Fed going to get away with cutting down to 3 and that's good enough? Like, to me, the answer is no on that. So I currently right now from peak to the end of this year, we're pricing in 58 basis points in cuts. Like, to me, that's not a recession. That's sort of just the market doing what it does to kind of have to hedge out. If anything, real rate's going to be so high at that point, they have to do some cuts just to defend, not having real rates get so tight that it really compresses everything. That's kind of the way I view it. And on stocks, I just don't think 22 PE is probably going to be the bottom if you're about to enter a recession. That doesn't make sense to me.
Okay, fair enough. Those are I can't argue with those. Jay, when you listen to Chase, what's your pushback, and like what do you think that you see so differently than him?
Just the idea that we're about to go into recession, right? I mean, Chase's point, and what led me actually, the whole genesis of this conversation was one of Chase's recent, pieces of work, which I love and always enjoy looking at. And it just struck me that, he was calling, and is calling, I believe, for an imminent recession. Imminent. So imminent to me is the next couple of months, as I think he said, May, June. There's nothing. Global PMIs are the best they've been in over a year. U.S. PMIs, S&P PMI, best it's been. You have housing, as I mentioned, already bottomed and turning up. You have transports turning up. The banking issue is not systemic. So I just really struggle to see the imminent nature of the recession call. And as I said, I think we're coming. We both agree that we're coming to a crunch period. Thus, the title of my musings on Friday: Crunch Time. And so I think we're within weeks of the Fed showing or stating that it's going to go on hold. And I believe that is going to be a catalyst for equities to go higher. And if that's the case, there's not a lot of space between where we are today and where we need to go to break out of the trading range. And once we break out of the trading range, I think then we are going to pull in all those bears. Barron's big money poll is an example, 6% bullish. JP Morgan's client survey, 1% thinks the S&P is going to be higher at the end of the year than it is currently. So once we break into that bear market space, we're going to have a lot of people join us because they have to, because they're going to be massively underperforming. So I just don't see the imminence really. And I think, as I said, the recessionary conditions in the U.S. were a year ago. Right. Same with Europe. They're not now, and they're not in the future. Most of the indicators looking forward, including the stock market, are telling you that growth is going to accelerate, not decelerate. And we had 2% growth in Q1. I think we're probably going to have something similar to 2% growth in Q2. And as we go into 2024, you have a global economy that's picking up much more aggressively and supportive rather of the U.S. economy.
Right. Okay. Chase, what would you say about the fact that often, or at least in recent history, when the Fed has paused, that has been a catalyst for a rally in the S&P 500. Do you think this time is different that way?
Yeah, I would say usually you didn't get a cluster of 75 basis point hikes that haven't even fed through yet. So yeah, I definitely think it's different on that end.
And I guess sorry, go ahead. I was just going to jump in. I think if you look back, whenever someone uses that stat, they use the recent history. And if you go back, I believe, to the 70s and the 80s, the last Fed hike was actually not a bullish point for the S&P 500. So it could be that maybe in this inflationary environment, we actually do roll over because they've gone too far. And I guess, is that the crux of your argument, is that the Fed has gone too far and is crushed private sector credit creation?
Yeah, I mean, I think they've gone much too far, but I still think most of it hasn't fed through, and I still think some of it's going to take months to feed through. It just with the way financing works, I think the Fed likes to stare at financial conditions. Traders really like to stare at financial conditions, and it's great to look at what stocks and bonds and the dollar are doing and all that, but what do real businesses get to finance at? Or do they get to finance? That's a much more important question for the real economy to me than what the dollar's at or like what the S&P 500's at. And we're starting to see that happen. Again, going back to that Dallas Fed survey that just came out this week, they're saying funding's dried up. We're being notified that our client line renewal may be difficult. They're talking about the rates being at the highest level they've paid since 2007. They're saying new orders are virtually stopping. Their customers have high inventories because they overbought last year, so now they're cutting back. They're talking about layoffs. They're talking about this is my favorite quote from the comment section on that. It said, "Business has gotten stupid slow, and we estimate having many days of just a few hours work to do to low volume." This is crazy. As business as busy as we were last year, and now for this year to have it turn off so quickly, it's hard to understand why. And to me, it's not hard to understand why. Like, we had a bunch of 75 basis point hikes, and that chokes off a lot of activity. Plus, everyone extrapolated that what the economy we had in 2021 was real, and 2022 was real, and it was going to keep doing that. And that to me, it was an absurd assumption. Like, that was a lot of demand on the back of shutdown and on the back of unbelievable fiscal stimulus, and that's largely gone now. So expecting what we did in 2020 and 2021 to create a perpetual motion machine instead of an economic cycle, to me is where the disconnect is here.
You guys are behaving so well and seem like such nice guys. Why don't I just let you two discuss it with each other? What would you ask Chase? Why don't you go ahead and ask Jay, and go back and forth and see if you guys can figure out where you might have some common ground?
Sure. So I know Jay and I do have some common ground on kind of the rest of the world theme that he has. I tend to agree with that, and I think we both see inflation slowing a good bit, and we've both kind of been on the same page on that really for a couple of years. But I think one of my questions I come to first, Jay, is do you put any stock into the leading economic indicators? And if so, how do you dismiss how negative they are and the fact that every time they've been here throughout history, we've had a recession?
Yeah, no, you're great points about where we agree, Chase, and you're correct on both of those. And I know you just wrote about Japan very constructively, and that's a market we've been quite keen on for since most of last year. Um, I don't really put a lot of stock into the leading economic indicators. I do think this time is different. As I said, the return of industrial policy to the U.S. for the first time in 70 years, the acceptance of a higher inflation rate and a high nominal growth rate world, the firebreak nature of the SVB failure, which told the Fed that it has to stop raising rates because the big winners of ZIRP, as you just pointed out, can't handle these rates. And I would take exception to your argument that people expect that to continue and are extrapolating 2021 and 2020. The market, the parts of the market that really boomed from work from home, as you know very well, have been absolutely decimated and are down 80 to 90%, whether it's Peloton or, name your favorite thing, whether it's ARC, any of that stuff. So I kind of take exception to that perspective. So I do believe it's different. I do believe that the market has absorbed the 75 basis point hikes. The housing market has absorbed it completely, which is typically where that really gets traction in your credit cycle with housing. We haven't had the layoffs that you normally have when the housing market crashes. And the housing market has already crashed, bottomed, and is recovering. That's an example of the speed that I mentioned earlier. So I think things are different, and I don't. I think we're, that the thinking about recession is a rearview mirror thinking, and we have to look forward here, and things are moving faster than we're used to.
All right, Jay, do you have just as good a question to ask Chase?
I wish I did.
I'm putting you on the spot.
Chase always has better questions than I do. He talked about if recession does not come, he'll have to get off his case, and he's very good at that. He moves very adeptly. But Chase, do you have I guess my question is, because we're really talking about the imminent nature of things here, do you have kind of a drop dead date where if you don't see like real clear signs of economic slowdown or significant labor job losses, do you have a point where you are going to kind of say, what, I'm going to shift, I'm going to hedge my position? Is it, if you don't see something by the end of next month, because May is here in a week, and you talked about recession and indications visible in May and June. So I wonder, is there a date certain by which, if you don't see what you're expecting to see, you're going to kind of move off it?
Yeah, good question. I think if we get to October and the labor market is still holding up as well as it has been called the last 3 months, then I would absolutely I'm just wrong at that point. Now I do think the economy starts to weaken a lot in May, but I just don't think you really see any of that until June, July in the data. And I don't, and just kind of looking at the trends and the leading indicators that I look at for labor markets, it's more like a July thing, where you kind of go negative on that front. But like I said before, cyclical jobs, which is where, recessions happen in the cyclical and industrial stuff. You can have services stay just fine even through recessions, much less right before them. I think that gets lost on a lot of people. You can basically just ignore services. They're largely just on their own and they're fine. It's all going to happen in the manufacturing side, and you're already seeing job losses starting to hit there. So while I do think we have to have negative jobs, overall, broadly speaking, I'm kind of more focused on those cyclical jobs. But yeah, no job losses by October, then I'm just wrong.
All right, guys, it's been a real pleasure having you on. I really appreciate you being here for the inaugural Market Huddle Plus episode. It's great to have you both on. And before we let you go, we'd just like to learn more about yourselves and where people that are interested in your views and the content that you provide, where they can find you. Let's start with you, Chase. Where can they find you these days?
Yeah, Twitter at Pinecone Macro. You can find my research at pineconemacro.com. And now that I've begun at Bulwark, you can find my work over there at Bulwark Capital Management. And you can just Google that and find it.
That's terrific. And how about you?
Yeah, I would just recommend everybody to follow Chase. He's excellent, and he's one of the guys that I read with anticipation every week. Here at TPW Advisory, we're a New York City-based investment advisory boutique. Really do global macro work, which I've been doing for close to 30 years. We have our tripolar world framework of regional integration in Asia, Europe, and the Americas as the way forward for the global economy. And we have a process where we write weekly, which really keeps us tethered to the current and to the future. And I think to be a successful global macro investor, you really need to do that. And we express our views through two model portfolios, both 100% ETF. One is a global macro portfolio, and the other is our TPW 20 ETFs that express thematic views across things like climate, future tech, aging, demographics, etc. You can find all of that and information on us and what we provide and sign up for our weekly musings at Pelosky.com. Thank you.
Great. Thanks, guys. Thanks for tuning in. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride.